There is an ETF sitting largely under the radar of most income investors that makes a claim you almost never see written directly on a fund company's website. Not that it seeks to match the S&P 500, not that it seeks to keep pace with the S&P 500 while generating income. It seeks to outperform the S&P 500 Total Return Index, monthly income on top, no covered calls, 5-star Morningstar rating, and a total return since inception in September 2019 of over 201% against the S&P 500's roughly 182% over the same period. That fund is OVL, the Overlay Shares Large Cap Equity ETF from Liquid Strategies. And if your reaction is that it sounds too good to be true, that is exactly the right instinct to bring into this analysis, because a claim like that deserves serious scrutiny rather than blind enthusiasm. Today on Dividend Desk, we are doing the complete breakdown how this fund actually works, why put spreads instead of covered calls changes everything about the risk and return profile, what the distribution change from 3.5% to over 10% actually means for investors, the tax structure, the team behind it, and the honest framework for deciding whether this fund belongs anywhere near your portfolio. Disclaimer first, nothing in this video is financial, investment, or tax advice. I am not a financial advisor. Past performance is not indicative of future results. Everything here is purely educational. Please always do your own research and consult a qualified professional before making any investment decisions. Let's start with the foundational question that drives everything else about OVL. Why does the structure of how you generate income matter so much? When most income investors think about option-based income ETFs, they are thinking about covered calls. You own an index or a basket of stocks, you sell call options above the current market price, you collect a premium, and in exchange you agree to have your upside capped if the market rises above that strike price. The premium you collect is distributed as income. This is the engine behind JEPI, XYLD, SPYI, QQQI, and essentially every major income ETF in the space. The covered call structure is not bad, it has legitimate uses, it generates real income, and in flat or declining markets it can meaningfully outperform a simple buy and hold position. But it has one structural cost that becomes significant over long periods in a rising market. You are capping your upside on an asset class, equities, that you own specifically because of its long-term upside potential. When the market runs 25% in a year, a covered call strategy might capture 8 or 10% of that move. The income partially compensates, but over a decade of broadly rising markets, the compounding cost of repeatedly surrendering upside adds up to a meaningful performance gap relative to the underlying index. Liquid Strategies looked at this dynamic and asked a different question. The income in a covered call strategy comes from selling options and collecting premium, but calls are not the only options you can sell. Put options, which give the buyer the right to sell the underlying index at a specified price, also generate premium when sold. And put options historically tend to generate richer premium than equivalent calls, for a specific and understandable reason. Investors are more worried about losing money than they are eager to pay for additional upside. The fear of loss drives more demand for downside protection than the greed for gains drives demand for upside speculation, and that asymmetric demand is priced into the options market. Implied volatility, the technical term for how expensive options are, tends to be higher on puts than on equivalent calls. Selling puts therefore generates more premium per unit of risk taken than selling equivalent calls. The critical difference for OVL is what selling puts does to the upside. When you sell a call option, you are directly capping your upside if the market rises above your strike. Your gains are capped there. When you sell a put option below the market, you are not touching the upside at all. The underlying equity position in OVL's case, essentially 100% of the fund is held in VOO, Vanguard's S&P 500 ETF, can appreciate without any ceiling. If the market rises 30%, OVL's equity position rises 30%. There is no call option overhead limiting how much of that move the fund captures. The income comes from the put side entirely below the current market price, and the upside is fully uncapped. This is the core structural distinction that separates OVL from virtually every other income ETF in the market. 99% of option income assets under management uses some form of capped upside structure. OVL is in the 1% that does not. But here is where the honest accounting of risk comes in, because selling puts without any protection is one of the most dangerous things you can do in a portfolio. If you sell a naked put option and the market crashes 40%, you are exposed to losses that can be catastrophic relative to the premium you collected. The entire history of income investors getting destroyed by put-selling strategies in bear markets is the reason this approach developed such a negative reputation. OVL addresses this directly by selling put spreads rather than naked puts. A put spread involves two simultaneous transactions, selling a put option at one strike price and buying a put option at a lower strike price. Let's use a concrete example with round numbers. Imagine the S&P 500 is at 100. OVL sells a put option with a strike of 98, expiring in 2 weeks, and collects 50 cents of premium. Simultaneously, OVL buys a put option with a strike of 96, also expiring in 2 weeks, paying 20 cents. The net income on this trade is 30 cents. Now, if the market falls to 90, a severe crash, the naked put seller who sold only the 98 option loses approximately 7.5 points after premium. The put spread seller using OVL's structure has a maximum possible loss of approximately $1.70 regardless of how far the market falls beyond the lower strike. The protective put at 96 kicks in and caps the loss. The trade still loses money in a crash. That is the honest trade-off, and it should be stated clearly, but the loss is defined, bounded, and known in advance rather than open-ended and potentially catastrophic. This defined risk structure is what allows a credible institutional firm to run a put-selling income strategy at scale without the tail risk that has historically made this approach too dangerous for most investors. The trade-off is real and worth repeating plainly. OVL will underperform simple equity beta in a significant market decline. When markets are falling meaningfully, the put spread will generate losses from the options overlay on top of the equity decline in the underlying VOO position. This is not a hedge product in the traditional sense. It is not designed to protect against drawdowns. It is designed to outperform across the much more common range of market environments: rising markets, flat markets, and modest declines, while accepting underperformance in the scenarios where the options overhead is most costly. The beta profile of OVL reflects this. The fund runs at approximately 1.1 beta, meaning it moves slightly more than the S&P 500 in either direction. This is slightly more risk than simply owning VOO, which runs at a beta of 1. But it is dramatically less risk than a 2 times leveraged S&P 500 ETF with a beta of 2, and it generates income in a way that leveraged funds simply cannot. There is an additional source of return that pure leverage products do not have. In a flat market, a 2 times leveraged ETF does essentially nothing. It tracks a market that went nowhere and generates no additional return. OVL, by contrast, is continuously selling put spreads and collecting premium throughout the year. In a flat market, that premium income is the entire source of outperformance, and it compounds across every 2-week options cycle the fund runs. This is why OVL's outperformance potential is not solely dependent on the market moving. It harvests volatility premium continuously regardless of market direction, with the important caveat that significant downward moves will hurt the fund more than they hurt the naked index. Now let's talk about the distribution change, because this is one of the most significant developments in OVL's history, and one that many investors who followed the fund in its early years have questions about. When Liquid Strategies launched OVL in September of 2019, the fund prioritized total return over income distribution. Most of the return was delivered through NAV appreciation, with a modest quarterly dividend of approximately 3.5% annually, roughly 2% more than what VOO paid on its own from the underlying stock dividends. For investors who were primarily looking at total return charts, the fund showed strong NAV appreciation that reflected the options income being retained and compounded within the price of the fund. But the market gave Liquid Strategies consistent feedback over those years. Investors wanted the income paid out, not accumulated in the price, paid out monthly in their accounts. The behavioral reason for this preference is well documented and genuinely rational. Income paid out monthly gives investors optionality that price appreciation locked inside a NAV does not. You can reinvest it, you can spend it, you can direct it toward another investment. You do not have to make a sell decision at a specific time and worry about whether today is the right day to liquidate a position. A pure price appreciation vehicle puts the timing burden entirely on the investor. You have to decide when to sell, and you can easily end up selling at the wrong moment. A fund with a predictable monthly distribution removes that burden and gives you capital to deploy on your own schedule. Starting in January of 2026, Liquid Strategies changed its distribution policy for OVL. The methodology for managing the portfolio did not change at all. The put spread strategy runs identically. The underlying VOO position is managed identically. What changed is how the total return is delivered to shareholders. Instead of most of it being retained in the NAV and a small portion paid as quarterly income, a much larger portion is now paid out monthly. The target distribution reflects approximately a 10 to 12% gross premium generation rate from the options overlay, which is what the strategy has historically been capable of generating based on a decade of running the approach. The current distribution yield sits at approximately 10.29%. This is the number that requires the most careful explanation, Because the reaction from many income investors when they see a fund jump from 3.5% to 10% is immediately to wonder if something has gone wrong or if NAV erosion is the source. The answer to that concern is specific and important. The total return of the fund, which is the combination of price appreciation and all distributions paid, should be essentially identical regardless of how much of that return is paid out as income versus retained in the NAV. If the fund earns 12% total return in a given year and pays out 10% as distributions, the NAV appreciates approximately 2%. If it had paid out 3.5% in the old policy, the NAV would have appreciated approximately 8.5%. The total return price plus income is the same either way. What changed is the delivery mechanism, not the underlying performance. The practical implication for investors doing their own research is critical. You cannot evaluate OVL by looking at a simple price chart on Robinhood, Yahoo Finance, or Google. Those charts show price only. A fund that distributes 10% annually will show a price chart that appreciates much more slowly than a fund retaining most of its return in the NAV, not because the total return is worse, but because more of the return is being paid out rather than showing up in the price. Always use a total return chart when evaluating any income-generating fund. Platforms like Stock Analysis, Y-Charts, and Portfolio Visualizer allow you to chart total return including distributions reinvested. That is the only apples-to-apples comparison that is meaningful. On the tax structure, and I want to be explicit that this is not tax advice and you should consult your own tax professional, OVL has three components to its distributions. The first is the qualified dividend income that flows through from owning VOO, the ordinary stock dividends from the S&P 500 companies inside VOO that receive qualified dividend treatment. The second is Section 1256 contract income from the options trades. Section 1256 contracts receive favorable 60-40 tax treatment. 60% of gains are taxed at long-term capital gains rates and 40% at short-term rates regardless of how long you held the position. This is the same advantageous tax classification that funds like SPYI and QQQI from NEOS use. The third component, expected to be the largest portion of the distribution, is return of capital, which is not taxable in the year received, but instead reduces your cost basis, effectively deferring the tax until you sell the fund. OVL publishes its 19A1 notices monthly on its fund page, showing the estimated source breakdown of each distribution, so you can track in real time what portion of your income is coming from each of these three sources. On the team and operational structure, because these are legitimate and important questions for any investor putting meaningful capital into a fund, OVL is managed by an investment team led by the firm's chief investment officer and co-founder, who has been trading options professionally for approximately 30 years, including experience as an options market maker on exchange floors and as head of an alternatives team through the 2008 financial crisis. The broader investment and trading team includes multiple experienced professionals, and the total firm manages approximately $1.8 billion in assets across its product lineup. The strategy is systematically structured with active oversight, meaning the core put spread process runs consistently according to established parameters, but the team actively monitors positions and will make tactical adjustments when the risk-reward of holding a position to expiration no longer makes sense. If the market moves significantly in favor of an outstanding position, and 80 or 90% of the premium has already been earned with several days remaining, they close the position rather than holding it to expiration for the remaining small amount of premium. That kind of active risk management reduces unnecessary exposure during the tail end of options cycles, and is part of what separates a systematically structured active approach from a purely mechanical rules-based system. The total expense ratio for OVL is 0.79%, which breaks down into a management fee, operational expenses, and the acquired fund fees from holding VOO as the underlying. All performance figures published by Liquid Strategies are net of this fee. The fee is already taken out of the returns you see on their website before any figures are presented. For investors trying to figure out how to research OVL in the context of their existing portfolio, the framework that makes the most sense is to compare it honestly against benchmarks that reflect what it is actually doing. OVL is an S&P 500-based strategy, so the right comparison is the S&P 500 Total Return Index, not just the S&P 500 price return, and not a comparison against higher yielding but structurally different income funds that might advertise a larger yield number while delivering worse total return. Look at how the fund performs in periods of significant market strength, where uncapped upside should allow it to participate, versus periods of market stress, where the put spread overlay will create additional drag beyond the equity decline. Understanding that behavioral pattern in advance is what allows you to hold the fund rationally through difficult periods, rather than reacting emotionally to a drawdown that was entirely predictable given the structure. The broader investment case for OVL rests on a specific belief about what equity markets will do over time. If you believe, as the historical evidence strongly suggests, that equity markets will be higher in 10 and 20 years than they are today, and you want to participate fully in that long-term appreciation without sacrificing upside through a covered call ceiling, while simultaneously receiving meaningful monthly income from the volatility risk premium available in the options market, and doing so in a tax-efficient structure that includes Section 1256 treatment and constructive return of capital OVL, is making a credible case for being a useful tool for achieving that combination. The 5-star Morningstar rating and the total return track record since 2019 provide some evidence that the thesis has played out as designed. Past performance, as always, is not indicative of future results, and the fund will have periods where it underperforms the simple index, specifically in meaningful market downturns where the put spreads lose money alongside the equity position. What OVL is not is a replacement for a pure index fund for investors who want the absolute maximum long-term total return with zero income requirements. VOO will likely produce a higher total return over very long periods than any income overlay strategy, because every basis point of management fee and every option trade with its associated transaction costs is a small drag on pure compounding. For investors who need or want monthly income alongside their equity exposure, however, the trade-off of that modest efficiency cost for a meaningful, growing income stream with favorable tax treatment is a rational one that deserves serious consideration. At Dividend Desk, this is the kind of complete, honest analysis we try to bring you every single week: the full picture, including the trade-offs, without either dismissing interesting opportunities or overselling them. OVL has earned attention in this space. Whether it belongs in your portfolio depends on your income needs, your time horizon, and your ability to hold through the inevitable periods where a put spread strategy underperforms the naked index. Think carefully about all three before making any decision. If this breakdown was useful, please hit the like button and subscribe to Dividend Desk. Join the Dividend Desk community link in the description. We will see you in the next one. This video is for educational and informational purposes only. It does not constitute financial, investment, or tax advice. Dividend Desk is not a financial advisor. Past performance is not indicative of future results. Always do your own research and consult a qualified professional before making any investment decisions.